Welcome to the I Nurture videos
and bonus stripping. We will also see some of real-life examples. When a company announces dividends, all investors holding its share on record date become eligible to receive it. Once the dividend is paid, the stock goes ex-dividend and trades at a lower price. We all know this. Then what do we mean by dividend stripping? If you happen to buy the share just ahead of the record date and sell it just after it goes ex-dividend, that is, after record date, you have achieved two things. One, you pocket tax-free dividend. Further, you can also book fictional short-term capital losses on that stock. You can then set off this loss against other profits you made to claim a tax exemption. This is dividend stripping. Of late, dividend stripping has been used mostly in mutual funds. Investors get information about a fund's dividend payout in advance and buy its units in advance. Once the dividend is announced, they collect it. The fund's net asset value, NAV, dips due to the payout. Subsequently, they book a capital loss and losses are then used to claim tax breaks. Reliance Quant Plus Fund is not a great performing mutual fund. It has always lagged its category and the benchmark Nifty in the past 5 years. Still, in June 2015, scheme attracted rupees 1,800 crore. The trigger was the rupees 4.2 dividend announced by the fund. On a net asset value of rupees 14.69, the dividend yield worked out to 28%. Within days, the fund's corpus grew 5,000% from rupees 36 crore to about rupees 1,900 crore as HNIs or high net worth investors poured money into the scheme to escape tax through dividend stripping. Some investors are using the high dividends to transfer money abroad. There is a limit to how much wealth can be transferred abroad in a year. No such limit applies to dividends. So, high net worth investors put money in the scheme, take the dividend and then move out. In 2004, dividend payout rules were modified by the Income Tax Department. This was done to discourage dividend stripping. The new rules specified that an investor can claim a notional loss on NAV due to dividends only if the units were purchased 3 months before the record date or were held for at least 9 months after dividend is paid. Bonus stripping is similar to dividend stripping. It is the practice of buying stocks or mutual fund units to take part in a bonus issue by companies. This allows them to book losses on the original investment value and then set it off to claim tax benefits. Dividend and bonus stripping provisions are governed by Section 94(7) and 94(8) respectively. Investors should resist the desire to go for dividend stripping if you are a long-term investor. If you have never intended to invest in a scheme and are doing so only for the dividend tax break, you could make a real loss due to market fluctuations in the holding period. If you aren't a dividend stripper but a long-term investor in a fund, please do not get attracted by sudden growth in size of the assets of the scheme. Many times, the popularity may not be due to performance of the fund, but due to dividend stripping opportunity. As a wealth manager, and more importantly, as an ethical tax advisor, please do not encourage such practices. There is typically a deluge of money into such schemes, which will also drain in a hurry. The exit may also happen when the market may not be favorable. These could leave your client to deal with real losses. Hence, our advice is to discourage dividend and bonus stripping strategies.